Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Todd A., Craig S., and Nick W. Returning to the program today is Brian Lax. Brian is the partner and portfolio manager at Old West Investment Management, a California-based hedge fund that participates in many areas of the market, including natural resources. You can learn more about Old West Investment Management via its website, oldwestim.com. Brian, it's a pleasure.
Hey, Andrew. Thanks for having me.
Well, Brian, by now I would have expected you to have packed up the horses and the cows and redomiciled somewhere in the Great Basin, say Salt Lake or something like that. But how are things at the Old West Group?
We're doing well. I think we talk about it every time, but there are pros and cons to living here. We try to focus on the pros.
Excellent. Well, that's positive and stay optimistic. Well, how's things going? And maybe give us your thoughts, just kick things off here on market conditions, both broad and maybe over in the natural resource sector. What things do you like? Anything have your attention, both negative and positive?
Yeah, well, I guess first we're having a great year, which is nice. We had a really strong year last year, so it's always good to follow it up. It's funny, if people say, how are the markets doing? Our natural response is always, which market? I think, sometimes there can be different conditions in different places. I guess if you're asking the overall market, I don't know. I haven't even really looked today. What's it? Probably up 50 bips, I guess, if I'd have to guess. I mean, it seems like that's either the state of it or maybe, down 2%, and CNBC's running their markets in turmoil, Chiron. But no, in general, I think it seems like markets are going well. I mean, the real question for us is, when does the Fed take their thumb off the scale? I think that's the big question. It's tough when you're trained in fundamental analysis and you get into an environment where all that really matters is what a single guy says every few weeks. Everyone gathers around the TV to watch him read the crop report. But for us, I think we've kind of found a little niche where we're able to hide out in some areas that have pretty strong fundamentals. And as long as the general market isn't too extreme one way or the other, I think we should do fine. And that's been proven out the last few years. I think going back a few years before that, people had questions because of our strategy and because we were in some of these areas that, you're only going to do well when the market crashes, or you can never compete with some of the high flying stuff, the FANG stocks, whatnot, the crazy valued tech stocks. But I think last year was a good proof of that. The market did well, and we did very well in excess of that, and this year seems to be the same. So I think really it just lends credence to the view that some of these areas that we've been in, that we've been patient about, are finally starting to bear fruit and doing well, even alongside a market that's also doing well.
Yeah, it seems that certainly some focus in other areas of the market that have been unloved for a number of years, and performance has been good the last 2 years over here as well. And I think for a lot of people on this area who continue to focus energy and natural resource sectors, base metals, even some precious metals on a select basis, still have done well. Anything particular that's catching your mind here as far as just attention for capital, other places maybe that you're rotating towards in terms of opportunities in oil, as you know, and coal has some opportunities, and things even like potash, and of course, there's uranium and base metals, et cetera. Anything in particular that's standing out to you here that hasn't gotten much love yet, or is it kind of everything is getting love?
Well, I guess some of the things that had been very unloved are starting to be loved. I mean, it wasn't too long ago, maybe a year and a half ago, we had negative oil prices. So now to see an energy shock, 18 months later is kind of ironic. So that's certainly getting more love than it had. Uranium, I mean, I don't remember the last time we talked, maybe a couple of years ago. That certainly hadn't been loved for a while. The first year or two that we started the fund, but now it certainly seems to be getting a lot of love. Probably the one I think that people are not so happy about, but maybe the fundamentals don't justify that, are the precious metals, gold and silver. We're not 2000 like we were a year ago, but a lot of these companies still make really good money at wherever we are today, 1750-ish. So it's funny to see how negative the sentiment has become. But for us, that's always a time to start looking at things and asking, is it overdone? Are there values here? And we still have a pretty big position in precious metals. We've had it for quite some time, and I think anytime people get really negative on something, and that's usually a time to think, hey, should we be adding here? Especially since some of the other parts of our portfolio have really been running in a strong way, and so your weightings start to get a little bit skewed more towards relatively performing better. And with that in mind, we've definitely been kicking the tires on a few more precious metals names.
Yeah, not a bad place to be looking right now in select gold and silver stocks, specifically at this point. There's a number of stuff on the safer side in the mid-tier space that makes a lot of sense on both. Actually, some fantastic prices over the last few months on some of those equities. So Equinox Gold, for example, I think is a perfect example of a place to be adding, even at current prices and even where the prices were a few months ago. Amongst many others, which I'm not doing it justice by mentioning one, but it's certainly a big position for us. It'll be interesting to see how things turn on that side of things. And then, of course, the base metals in a good direction. So, yeah, lots of opportunities. Unfortunately, just not enough capital to go after some of these. And of course, you're right. Uranium skewed the portfolios a bit as well recently. So maybe let's talk about uranium for a moment. Any particular comments on recent market events over the last few months? I know, back to reference, you and I haven't spoke since December 2019 for reference for the audience, but any thoughts on the uranium sector here?
Yeah, I don't know. It's been pretty quiet. I haven't really seen any news lately. No, actually, we've seen a ton of news, and it's been a huge change. If going back to when we talked, I guess, with 2019. The fundamental setup just continues to get stronger every day. I think the difference these days is that people are paying attention to it. I mean, just today I walked into the office and our CIO was showing me that uranium story in the Wall Street Journal was front page of the middle section there, and kind of pretty prominently placed. Used to go, if you go back a couple of years, you used to have to dig into obscure industry rags to find any sort of news there. The fact that you're seeing it in all these more mainstream outlets, I think, is a really big change. A lot of them are still pointing to or ascribing it to day traders or Wall Street bets or Reddit or all that stuff. I think the quality of the reporting is getting better in terms of them needing to see that there's actually some fundamental stuff driving this market. And it's happening slowly but surely. But yeah, uranium is kind of one of those exotic ideas that people like to point to as having the potential to really catch a mania. We've talked about it in some of our past interviews. I mean, that's not the primary reason to be involved, but it obviously adds some fuel to the fire when people start realizing how strong the fundamental setup is. Obviously the big news this year has been the Sprott Fund and what they've done. It just seems like it's only getting warmed up as well. I mean, they don't even have their New York listing going. It seems like it's in motion now, but man, they've really come out with a bang there, spending whatever that was, $500-600 million in the first month and a half. So we're happy to see that. Obviously, you've seen the spot price go up from low 30s to mid 40s. It's got above 50. The equities have run in tandem with it, and really the main thing that we like to see is that there's just more interest in the space. I mean, we've always maintained that the fundamentals were never the problem here. The problem was that no one cared. No one was looking at it. I mean, you had such a long downturn for so long that most of the investment community had just abandoned the sector. And so when things started perking back up, there just wasn't that natural level of interest. And so many of the companies have either gone away or were so washed out, there just wasn't a lot of sector coverage in the financial community. So it was sort of a perfect storm, but that was a great time to be buying equities in hindsight, which is what we were doing for a couple of years, building positions in a lot of these names. Now it's nice to see that strategy paying off. It was a long year or two trying to tell our investors, hey, look, this is happening. Here's the setup. Just be patient. It's going down. We're building positions in these things while no one cares about it, and just let it turn the corner and you'll see what happens. And I think that strategy has really paid off in a big way. And it looks like it's just getting going. I mean, I know the stocks have run a bunch in the last year and a half, but spot price is still, or uranium price is still sub 50. I mean, we think it has to go a lot higher just to balance the market. And so I think we're really only just getting started.
Lots of key events have yet to take place, and early stage here, I know that a lot of folks think that that's not the case, and it's too easy to flood this market. I firmly disagree with that. And I think that these supplemental vehicles like Yellowcake and of course now Sprott coming into the market and re-energizing and weaponizing Uranium Participation Corp, I think is useful. But then also, this nice extra piece of news with Kazatomprom coming out with another vehicle, hopefully to be listed, which sure be nice if it was listed somewhere else, Singapore, Hong Kong, elsewhere. It would be nice to see something pop up on the ASX as well, Brian, because I think having vehicles like this listed around the major global exchanges makes a lot of sense from a standpoint that it kind of takes any thunder out of the SEC's review of a New York listing for SPUT. So, I think it's good to see these various vehicles out there, and it's good to see that investors have these options. Obviously, the way that the Sprott vehicle set up far superior to Yellowcake at this point. Not a lot of capital raises yet that I'm seeing in the sector equities. Not a lot of news items yet. Not a lot on M&A yet either. So it's I think everybody is still in kind of shock mode a little bit. Maybe there's some strategizing going on, but yeah, lots of interesting circumstances here.
Yeah, I guess somewhat surprising that you haven't seen more juniors hitting the bid and dumping a bunch of equity onto the market. I mean, that's been their MO for the longest amount of time, and they were doing it at a lot lower price levels. So you would expect to see some of that. I mean, you've seen smattering here and there, but in general, who knows? Maybe they finally said, this thing's got a long way to go, and maybe they're holding off for better prices. But in general, I think that all the news is really constructive. That Kazakh fund, it looks like they're targeting more of the kind of Asian market, Australasian market with that. So Yellowcake's got Europe, and Sprott obviously North America. I agree with you. I think the ATM setup for Sprott makes it just far superior, the way they can go in and out of the market every day. I heard some people complaining about Yellowcake. I think it was trading a pretty big premium, and they haven't really done much. But in general, I think just the more we see buying from the financial community does a few things. One, it puts price discovery into the market, and two, it gives utilities a little bit more incentive to go out and start taking care of their own needs. The talk was always, how do you go sign a contract for 50 when spot's at 25? We're not really trying to make a call here, but if you get the market's at 50, well, it's much easier to start signing contracts. And the utilities are pretty decently covered the next few years, but they still got to come to the market for the following years and the 10 years after, or through the 10 years after. So I think you've heard talk that these contracting discussions have happened. Cameco has done quite a bit of contracting. You're starting to see some RFPs out there. So the wheels are in motion. They turn slowly, but it is very constructive. And in the meantime, having all these funds out there snapping up pounds and trying to prove how liquid the spot market is, I think is just a positive.
Yeah, I think Spot's somewhere in the neighborhood of 80 million pounds volume so far year to date, and long-term contracting's for the year to date 53 million. So yeah, it's good to see that part of it too. And with prices as things stand, you have these willing buyers in the market, like Sprott. You don't have to necessarily. I guess you could use broker networks if you wanted to help pass it around, I guess. But some of the small ISR producers, you see companies in Australia that have 700 million market cap on an ISR project that might need to raise 50 million for their stage 1 project. Not a lot of speed on that yet. ISR producers in the US, 6 months, 8 months, 12 months restart times, CapEx 15, 20 million. If the costs are what they say they are, then why not start clipping some pounds if you can pump out, not much of anything for this market, 50 to 80,000 pounds a month, Brian. Take some cash flow here. It'll be interesting to see what the strategy is here, because I know there's some strategizing going on behind the scenes, but some of these small ISR quick restart producers have some good opportunity if their costs are what they state that they are, which I'm suspicious that they're not fully that way, and that inflation is also going to help bring those costs up. But it's going to be interesting to see who's swimming naked when the tide comes out on this one, because that to me is an interesting standpoint where you have companies that are obviously in the money here, and will they make a move? And if they don't make a move, you have to question their intentions.
Yeah, well, also I think you said it perfectly. If the costs are what they say they are, that remains to be seen. We'll see if some of these guys start to ramp up. We really like Kazatomprom here because they already have the production, and they can ramp it up if they want. Obviously they've said that they were going to keep it pretty flat here through 2023, but those decisions to start ramping in terms of capex and production outlook, probably happen sometime around middle of next year for 24. So in that case, you are looking for companies that do have existing production. The interesting thing for some of the other juniors, with some of these ISR projects is, it does take capital, it does take time to ramp up, even though they can do it relatively more quickly than a hard rock mine. But you have to distinguish between what's happening in spot and what they can actually capture in terms of term contracting. I think going back a few years, we were never really that interested in the spot vehicles, just because one, the uranium equities themselves were so bombed out. I'm talking 2018, 2019, that even though spot was whatever it was, $20-25, if you had a view that it was going to go to 50 or 75, the return that you'd get from owning spot was going to be dwarfed by the return on the equities themselves. That changed a little bit when, one, the stocks have run over the last 18 months, putting it a little bit more on parity since you're starting to price in a little bit higher number. But two, because now with this Sprott vehicle in there, there's a possibility that the spot price runs so much, just you get squeezed by a market that can't handle all their buying, that really you see it run, but the term price doesn't necessarily keep up. You could have some backwardation for a while. And what in that situation, you actually would want to own the spot vehicle because you're going to capture that rise, whereas the equities, which are supposedly, should be discounting mechanisms for, what they earn over the life of their mine, may not, might call the bluff and say, well, this is just a temporary spike. And so that, the equities might only price in 80 long term or whatever it is, pick your number. And so that was a little shift that we had, we talked about it a little bit in our letter earlier this year, was, going back 2 years, our view on these spot vehicles was, if you're right about uranium, you're going to get paid more in the miners. And if you're wrong about uranium or you don't like thesis, well, you probably don't want to own anything. And so they kind of sat in this middle ground. We thought maybe we'll own some as a cash substitute as we're looking where we want to deploy it. But in general, the place to be was in the miners. And I think the return that you've seen over the last year or two really bears that out. But now you've gotten a situation where, who knows where this buying power is going to take the quote unquote spot price. They could, obviously they've overwhelmed it in the last 6 to 8 weeks. You've seen it move pretty quickly. The real question is, do the equities continue, if it continues to go up, let's say it goes to 60, 80, 100, I don't know, higher. Do the equities at some point start to say, well, wait a minute now, we have a 10-year mine life or a 15-year mine life. Are we going to, if spot squeezes to 150, should we really be banking that in, that we're going to get 150 every year for the next 10 years? That dynamic is something we're watching for, because we actually think, no, in some cases you may see the returns keep going to that spot vehicle, but the actual miners themselves might hit sort of a diminishing return there, as essentially calling the bluff and saying that whatever spike is there is going to be short-lived. And so maybe there's a little bit of that with the mentality of some of these junior ISR guys, in knowing that, the spot price is running here, but if we're going to go raise a bunch of money and we're going to actually do this, are we going to be able to get these types of prices? Because look, the utilities, they're slow to contract there. The guys that are going to get the big contracts are obviously the big, companies. Cameco's out there doing it, Kazatomprom. You got to think, are these little companies going to be able to get the levels they need? And there's a little bit of a game of chicken, which is, do they want to sell so soon? Yeah, to your point, they do get a little bit of cash flow in the door, but do they really want to give up any potential upside right now? You've seen Cameco catch a lot of flack in the last few months because of the how conservatively they're structured in their contracts. People saying they got a bear market mentality, or they're giving up all their upside. There might be a little bit of that even in the juniors, saying, why are we going to sell our ISR pounds at 50? We lied in our said we could produce it at 30, but really it's probably 40 or 45. And so, yeah, we might make a few bucks, but maybe we want to wait and see how far this thing really goes.
Yeah, I think there's a component of that. I mean, obviously the size we're talking about, this is small quantity, insignificant. Even if you add some of them together in the U.S., still insignificant. And the fact that it's going to take them 6 months here to get out and maybe actually going. Will they get the nameplate? Probably not. From there, if it's pumping out 90,000 pounds, a month, if you're lucky, over time, yeah, of course, you'll be able to capture different price points and maybe help out pipeline development projects with stacking a little bit of cash flow back there as well. The bigger guys, you don't have that type of optionality. You can't dump large quantities on the spot market, and it will be tried probably at much higher prices, as you state. But the term contracts are so much more meaningful and important to those larger producers. Yeah, interesting dynamic, Brian. I mean, an air gap spot price at $90 versus a long-term contract being entered into at $65. There, that air gap difference. How will the equities respond, as you say, when there's a spike? All yet to be seen, and it's going to be interesting to see what individual strategies come out as well. And then, of course, actually seeing what these numbers are being reported once production actually gets there. The inflation on capexes on these billion-dollar projects, what that looks like. And I think we had a very good indicator of that looking over at copper development projects that are $1 billion plus, $2 billion plus. You can tack on 25 to 30% on that capex, and that's an understatement. I think that people are going to be surprised to the upside on what some of these capexes are actually going to come out to be.
Yeah, well, there's a couple parts to that question. I think on the capex, everyone likes to run their models of these projects and play with the price and say, oh my gosh, look at how much upside there is. If you're being honest with yourself, you probably should be running some sensitivities on the capex too, because that's blowing out in a lot of places. I did that interview with who was it, Jose Maria, a few weeks ago. That's a $3 billion bill, and they're talking about 10% overrun at least. Man, it gets pretty big pretty quick when you have a tiny market cap in comparison to some of these larger projects. For the smaller uranium guys, in hindsight, it looks like some of the best decisions they made were to go out and buy some physical. As crazy as it sounded, and they caught some criticism for it when they were doing it, but even today at whatever spot's at, I don't know, mid 40s. For some of them guys, if they're honest with their full all-in cost, maybe they should still be buying more physical, especially if they're able to, that they can turn around and sell faster than they can wrap up their ISR, obviously. So, yeah, it'll be interesting to see what they do. I still think it's probably more difficult for a junior company to get some contracts signed, especially one that's never produced before. Maybe some of the guys that have historical production might have an easier go at it, but it's just difficult, right? If you're a utility, why do I want to go and get some guys, like you say, 90,000 pounds a month or whatever, and maybe they'll produce it, maybe they won't. I don't know. Who are these guys? What's their history? I think there's a lot of that going on when I can just go, lock up bulky pounds somewhere else, as long as I'm willing to pay a little bit more. We'll see. I think that it goes to kind of the surprise of, why haven't the juniors come out and raised a bunch of money? Yeah, that's something you'd probably have to see happen first. I don't know, maybe simultaneous, but if they're really going to develop these things, they're going to need the money to do it. Where are they going to get that? You'd think that if they were serious about doing it now, I mean, obviously there's some lead time. Yeah, it's a little bit quicker, but there's still some lead time, so they got to go do that. We haven't quite seen it yet, but there's a lot of that. The consolidation potential, we don't really own a lot of the U.S. because it kind of falls in that middle ground of, they're not very large deposits, they're not really that high grade. Yeah, you can turn them on quick. I guess is a pro there, but in general, I mean, we either go to some of we like the really high grade stuff that's chunky, or we like some of the current production that's low cost. And a lot of the other development stuff that's higher cost is, maybe stuff in Africa where you've got a similar short lead time, but it's actually got a little bit more scale. And so, we do own a little bit of U.S. just because, but in general, we're more observers of that space and, interested to see what happens, but yeah, it's not really as big of a focus for us.
We're discussing some of this in our upcoming letter. And when you have a company in the U.S. that has, a 400 million market cap, and they say that they need to raise 15 million to bring this on in 6 months or whatever it may be, that's a relatively simple hurdle to get over here. And I think some of the companies too, some of them have cashed up a little bit prior, some are okay on cash position, but it is overall surprising that, a lot of these equities haven't come out and done more raising. And then I think on the smaller quantity production, I think one of the things to prove out to potential future term contracts, Brian, is for some of these companies who say it's relatively easy to restart an ISR operation, go ahead maybe and do it here because, stacking pounds away at this point probably makes some sense. That's not a problem if for some reason the price temporarily jumps back down to $32 for a time. We know that's not going to hang out that long. But to demonstrate to utilities and potential clients in the future that, hey, look, we are producing pounds. Yeah, it's only 60,000 pounds a month, but we are producing. And maybe if you're a U.S. utility, you might have it's not an obligation at this point to do Buy American, but maybe there is some kind of ethical part of that to say, you know what, we should probably source some pounds locally for the farmer's market style. I think that's also a way to look at it too, is to demonstrate that, look, you don't know who we are, but we're actually producing, and here we are now, and we're showing that we can put cake in a can, which I think is going to be a big challenge here for a lot of these companies.
Well, and you said it. I mean, some of these guys have their market caps now are 300 or 400 million. So to raise 20 million bucks, you're only talking about 5 to 10% dilution. Go back a couple of years, that was their whole market cap, right? I mean, some of these stocks have gone up tenfold in the last 18 months, and so now's the time. I mean, unless you think, going back to what we were talking about earlier, that they think, well, maybe their market cap goes to 600 million. I don't know, but yeah, if you want to start. I guess that would be our idea. That's why it's so interesting to see them pausing here. But maybe everyone's just been taken so much by shock with how fast and the move has been here that you've got kind of people waiting and seeing what's going to happen next. Sprott still has whatever it is, 600 million or so left in their ATM. I mean, they've made a big splash in this market. Maybe they think if that thing gets exhausted in the next month or two, we could be sitting at $60 or $80 spot, and all of a sudden their stocks have doubled again, and now that dilution's only a couple percent. So I don't know. I mean, you'd have to really talk to the company on a case by case basis to see what their thought process is. For us, we follow fewer companies these days. We've talked about it going back a few years that when we started this thing and everything was really washed out, we took more of a basket approach just because we thought everything was so beaten up that when this thing finally turns, a lot of boats are going to rise, even the ones that have holes in them. As the valuations have gotten better and better, you got to sharpen your pencil a little bit more. There's still room for the whole sector to run, but we've gotten a little bit more concentrated just because we think that, okay, whereas we were willing to expand our quality filter just in the early days, as these things have gone up 5 or 10-fold, you buy a stock at 1 and now it's at 8, the risk reward's a little bit different. And so, it might not be as big of a position if we even still own it. It seems like there's new companies coming every day. I mean, what's the sector? I don't know. There used to be only a few dozen. Now there's maybe 50, 60. It seems like a lot of the Aussie ones are coming out, buying land out in the U.S. And so it's hard to keep track of all the stuff doing stuff. I think over time, we've gotten a pretty clear picture of who's got really high quality projects, who's got a clear path to production, and we're really just kind of focusing there. And then, as you mentioned, always keeping an eye towards what are some of the next sorts of opportunities that have this same dynamic, because even though we expect and have expected this theme to play out over several years, it's possible that the timeline gets accelerated just because of the flood of capital that comes in. And so we actually talk about this fairly often, is what happens if Sprott comes in and jacks it up to 100 in short order, say end of the year, I don't know, or the next 18 months. I mean, you might see the valuations on these things go crazy. Throw in some of the Reddit crowd, and you get a perfect storm for some of these equities. You might get to your expected 3 to 5 year valuation in 3 to 5 months, or some short period of time. What are we going to do in that scenario? So we kind of constantly war game stuff like that, and think about what you've talked about in your stuff before, exit strategy. I don't think we're anywhere near that yet. I know you watch the news and CNBC or whatnot. They talk about the Reddit crowd and all this stuff. I mean, those guys, yeah, maybe they've nibbled on it a bit. Maybe you saw a little bit of that earlier this year with like a name like Denison. But in general, I think if you look at the volumes that were traded in some of those meme stocks, I don't think we've even gotten close there. You are definitely seeing more chatter pick up in social media, in mainstream news, and so I think the recipe is there. Whether that actually happens, we'll see. But for us, I guess the main takeaway would be what happens if this thing, if the thesis plays out a lot faster than we expected. I can say that having been in it for a few years, knowing that it's been much slower than we would have wanted in 2018 coming into this thing. But, that's one of those things where it takes years to be an overnight success. It's all of a sudden happening all at once here. And so we'll see. I still think a lot of these things have a long way to go. But it's possible that the speed really picks up.
Well, maybe this is a 3 different times trade, one on a frenzy, one on a market crash, broad market crash, and maybe one on fundamentals, because you and I both know that bringing the price to $60 and it stays there for a day or two does not solve the problem, and that Chemical filling its order book and Kazatomprom filling its order book, and they capitalize all their projects that are restarts, still does not solve the problem. And so, maybe there are those opportunities there where this happens a couple different times because of different reasons. You and I both know that keeping the uranium price at $65 and higher for a period of years might actually start to solve the problem when projects actually get built. There's some different ways to look at it. I agree with you. I think that there could be some potential here, trades a few different ways based on some different reasons.
Yeah, and we've talked about that. A lot of the research and work that we did on the uranium sector was done in the last few years. A lot of the work we do today is actually on other areas, trying to find what has the next potential for that sort of setup, so that when we do get to the point where we start harvesting, we can start redeploying that stuff and keeping the fund evergreen. And also, the fund I manage is heavily focused in natural resources, but we also have a number of other funds that are more diversified. And so we're always looking for what's the next thing. And that doesn't mean that we're just about to abandon uranium. I mean, we still, it's our largest sector weighting by far. And so I don't want to come off as sounding bearish, but at the same time, if a frenzy does hit, we won't be afraid to trim a little around the edges and maybe plant a few seeds in some other areas here. I don't think we're necessarily there yet. You've definitely seen valuations improve, but I think the way we've really handled that is by concentrating, the cream rises to the top. If you had something that you were a little bit questioned about, but you think, oh, hey, it fits in the portfolio, well, the stock went up 5 or 10 times. Well, now it's a little bit more of a show me story. Maybe we'll add to something where, the valuation is much stronger, or, gives it a much stronger foundation. And in the meantime, if there's a little bit extra left over, maybe we'll start seeding some of these other areas. And, we get pretty steady flows into some of these funds. So there's that we can use as well. So we don't necessarily have to trim. It's almost like a pseudo trim when you have money come in, because it dilutes the value of all the positions slightly. And then you have some cash and you can decide where you want to deploy it. Well, if relatively some of the stocks in a certain sector have run 100% in 2 months, well, maybe you might want to buy a little something else and build those positions, something that hasn't quite worked yet, but you think still has very good potential. So yeah, there is portfolio management that takes place around the edges, but in general, we have some very large core positions in some names that are probably familiar with a lot of your listeners. And I think the hardest thing to do is to just let them go. There's always a tendency to want to do something, whether it's, oh my gosh, stock's up 10%, should we sell it, or it's down, what's going on? I think we've gotten pretty habituated to the volatility in the sector, just having ridden it both ways. And so probably the best thing to do is, shut off the screen sometimes and just say, look, fundamentals are getting stronger and stronger. Valuations aren't necessarily close to where we think they have to go. So let's try not to be whipsawed too much by what the actual stocks are doing and let it go.
Brian, I want to come back to the company size and also the thought process behind coming down the food chain here as certain things get loved and other things don't get so much love in the sector. But you're part of a fund. You speak to other institutionals in the US and globally. Do you hear anything from them talking about uranium? Maybe there's some other funds that are in uranium that talk to you. What's the thought process on uranium? Is it pretty much crickets out there, or is there other places that people are also looking that's been discussed?
I guess there's two ways to answer that. One, there are definitely new people looking at uranium. I think if you went back a few years, it was a lot of sector specialist guys that were launching funds just for it, or maybe there were some commodity guys that were also starting to look at it, some of the metals guys. The big shift is seeing a lot more retail participation and also seeing a lot more generalists. I think that's been the real big one is you have had institutional investors. It kind of creeps. It goes from the specialists to the guys that have commodity funds, and then it goes to the guys that are looking at energy. But more and more, you're seeing some institutions start to look at uranium and giving us a call, because obviously we're a pretty big holder of a lot of these names, and so people reach out to us all the time. But I guess the other way to answer that question is there are other areas that people are looking at. I mean, you mentioned a few of them earlier in the call. Natural resources just looks like a fantastic place to be. And we can go down the list of why that is. I mean, it's hard to imagine a better environment for commodities and raw materials. We used to tell people, pull out the periodic table. I mean, if you want to see what we're looking at for investments, I mean, and now that used to sound kind of bizarre, but now, I mean, some of these metals that people are talking about, I mean, they are really going deep in the weeds here, finding some niche stuff. I mean, we mentioned tin in our last letter. That's one that's, got a lot of people talking about. There's a real squeeze going on there. Go down the list. You mentioned copper. I think that all of these raw materials that people need in an inflationary environment are going to be an incredible store of value, and we think a good place to be invested. As long as you find the companies that can actually produce it, they produce it at a decent cost, and they have some scale. I think that's kind of the thing that we're looking for. And so, you made a good point earlier, which is that it's hard to really invest in everything. I mean, we got guys pitching us all kinds of stuff, helium, and I can't even pronounce some of these things, but it's difficult because you want to invest in everything, but you gotta pick and choose. You gotta kind of force rank these things, because they're going to compete for your investment dollars. And so for us, I think when we're looking across the natural resource sector, I mean, one of the natural things to do, I'm mostly focused on the metal side. I know, I was an oil and gas guy once upon a time, and it's great to see what's happening there. Maybe not. It's all the anti-ESG things that are working right now with this whole energy crisis going on. But I'm mostly focused on the metals because I think we've talked about it in the past, but this whole clean energy transition is really depends on a lot of metals. I mean, that's one of the things we spend a lot of time, listening to these Senate hearings and reading these, agency reports, and all of these energy hearings, they talk about mining the whole time because it's batteries, it's solar panels, it's all this stuff that's needed for this whole green, clean transition. I mean, it's just a huge step change demand for metals. And so for us, we look out and there's all these different areas that people are scrambling for attention, whether it lithium or cobalt or nickel or whatever it is. I think the way we've sort of approached it is to say, look, all of these individual markets have their own supply demand characteristics. What does that future supply demand look like? Which ones are tight? Which ones are not so tight? And knowing who has the tightest supply demand probably gives you a good area to start with. And then once you have found that's the commodity you want to focus on, then you kind of go down the list. Okay, who's got the supply that can be brought online? Where are the big low cost? Who are the next gens of XYZ commodity? And then you can start doing your work there. And so I think that's one way we've found some of our investments and how we've approached looking at some of the new investment ideas that are starting to make their way into our portfolio is that sort of framework of saying, which commodities are really seeing a step change in demand that's going to have a hard time for supply to catch up, and then who's got the great source of supply that can actually get built and meet that.
Lots of parts, and there's just not enough hours in the day, and there's not enough capital to kiss all the girls, or if you're a woman listener, kiss all the guys. it's tough. And then you throw the Great Plague into things, Brian, and you've got a lot of disruptions that are happening, and also just the sheer time to really dig down and do a uranium-like analysis like you have and like I have and some other key founders of this cycle going back to 2016, 17, 18. It's a lot of work and it takes a lot of time. And of course, we all have daily lives as well, which eats into that time frame. But yeah, in general, energy, natural resource areas are going to be pretty well liked here. And I think you have to pick your profiles that make the most sense, as you indicated, and also pick ones that you think can outperform some of the others. So if you see things like copper and silver and things like uranium might outperform oil and gas, then obviously you're going to allocate more towards those over oil and gas. Back to the company size back in the uranium sector, we've got NextGen's a third of Cameco's market cap. Denison's about half of NextGen here in terms of market cap. Paladin's about 2/3 of NextGen in terms of market cap. Just for reference here, these companies are getting into the billion, 2 billion, 3 billion plus areas. What's your thoughts on moving down the food chain and adding to positions that you might have that are already in place that are maybe a sub-billion market cap? Do you think that makes some sense as things continue to roll here, or do you stick with some of the larger ones? I mean, if you're a company like Paladin, for example, you've got to be asking yourself, boy, how do we maintain this market cap? How do we grow our market cap? I mean, what do we do here to keep this market cap? Got to be some questions some of these companies are trying to figure out here as to what their strategy is, if they even have one at all.
Yeah, well, I think we're less concerned about just market cap in an absolute sense, and the way we approach it is to say, well, what are these? Go project by project. What is this project worth at X price, Y price, Z price? Give them just the mine life. Give them a longer mine life. What do we think is going to happen? We run all these sensitivities, and then we say, what's a kind of a good valuation range for this? Some of the larger companies might do just as well as some of the smaller ones, especially because it looks like some of the smaller ones have maybe outperformed. You mentioned Paladin. That's been a huge, what was it, 3 cents a year and a half ago. So, yeah, I think it's a case-by-case basis. I don't think you can just say, well, I don't like NextGen anymore because it's, 3 or 4 billion. I want to go to, whatever little tiny company because it's very small. You got to go by what's the project. And that's why I said, we might have been willing to do that, a year or two ago when we owned a bunch more companies, just because we said, look, everything is so small. And any sort of capital flowing into this thing is gonna boost these things up. But as we've gotten bigger and some of these things have gone up 5 or 10 times, well, now you have to scrutinize them a little bit more and say, well, wait a minute, is this valuation really justified? And look, we're not to the point here where we're saying, we need to go short everything. I still think valuations are going to get to places that are just as crazy on the upside as they were on the downside. And then for us, it's just a matter of preference of how much we want to participate, and how long we want to stay at the table while these things start going crazy. Because the more and more we think about it, the more and more we do think that you probably get an overshoot on the price, uranium price, just because of the lead times for some of these projects. Once the utilities cry uncle and say, okay, we'll pay what we need to pay, well, great. All right, now we'll start, raising the capital and building the mine, and hopefully we have the permits, and that stuff takes years. So that's how I think you get an overshoot scenario, and why you talked to the industry observers a couple of years ago, they said, look, this thing should have already started taking place. The fact that it hasn't and it's been delayed for so long just gives more fuel to that fire that eventually you may have an overshoot to the upside. So we think about it that way. But no, I don't think we're necessarily trying to target a specific market cap. If anything, I would maybe say the average market cap has gotten bigger, and not just because all the stocks have gone up, but because we've become more concentrated. And I think some of the bigger names are going to be some of the biggest winners. We really like NextGen. We really like Kazatomprom. I think that's probably the best developer and the best producer that's out there. You can just do some napkin math on both of those and see that they should probably be worth a lot more, especially if you're optimistic about where the uranium price. Even if you're not optimistic about where the uranium price is going, if it's at 50 or 70 even, these guys are going to make a ton of money here. I think it's more difficult as you go down the food chain, because then you have to really start to question, are these things going to become projects? The reason that they're probably smaller is they either have smaller projects and then maybe they're appropriately valued, or people are kind of just trading them like trading sardines and saying that maybe they continue to go up as everything gets swept up. But in general, no, I mean, we haven't really targeted a certain size factor. I think that we're just looking on a case by case basis, and really where we've decided is to say, look, rather than add another name just because we're trying to get a tiny one, well, maybe we want to add another sector, like another metal. Maybe we want to buy some tin. Maybe we want to buy some silver or some nickel or whatever the hell it is, copper. That's kind of the way we've approached it, is saying, look, if we think that these stocks have gone up so much that all of a sudden the risk reward is now not as attractive and it's going to force our hand to find something else, well, maybe some of the other things we're looking at have a similar risk reward as these things did before they had gone up so much. So I think that's probably the way we look at it. I mean, we do a few of the smaller ones, but in general, no, we're less concerned about the absolute size and more just about what is the upside from the current price.
No, good points. I think you have to look at some of these on an individual basis. And in this market conditions, some of this conventional metrics get thrown out, as you know, and that eventually the market does come back to fundamentals at some point, and discounting out projects that may not cash flow for 7 years or 8 years or whatever it may be, and the CapEx involvement, and then also the discount for management. What is that discount and the capabilities of a management team to bring something on, or does it need to go to somebody else? The complexity of these projects, I think you have to do some extra work here and really look at them on an individual basis first. How about shorting natural resource stocks, given where we are in the cycle across the board, when a lot of the things we've talked about here? Do you feel it's worth your time to try to short natural resource stocks in this cycle when it only means that you might make 50%? What's thoughts on that?
Yeah, I know there's probably some guys that have to do it as part of their mandate. It's just playing with fire for us. I mean, it's the pennies in front of the steamroller. We don't. Look, there's a couple ways to think about it. One, I think we always get a little nervous. I guess this is how you're wired when you're a resource investor. We always get a little nervous when things are going right, because we're so used to buying something and having it, lose half its value in the first 6 months, that when you actually start doing really well, you start saying, well, wait a minute, how do I get blown up here? So we're always looking to potentially hedge somehow, or to protect either our gains or to protect against the downside. I mean, as you've seen, these things can turn on a dime. I mean, just look at the uranium sector over the last, 4 to 6 months. I mean, they peaked out in June and they crashed through August and fired them back up through September. And then there was a couple of days they just got destroyed. So you really get whipped around here. We're not necessarily trying to protect against that sort of volatility. I think the bigger concern we have is an overall market crash. I think it's nice having all these investments that benefit from this crazy inflation that we're seeing. But at some point, you imagine that the inflation is going to bite and might put a real damp on, crimp the economy pretty badly. And if that's the case, what's going to happen to the overall market? And if the overall market goes, I mean, nobody's really going to get spared. And so I think from a hedging perspective, we've been more of the mind to protect against an overall market disruption. And so, most of our hedges are sort of tail hedges, just because it's been a painful 10 years to try to be cautious at all. As you've probably seen, I mean, it just hasn't really been rewarding to be short anything. I mean, there's been pockets of opportunity there, but in general, I think valuations have the fact that the central banks have essentially taken over the market. It's very difficult to do valuation-based shorts in any sector. I mean, you've seen just craziness go on, especially in certain pockets of tech, and some of these things where that we've long since gone to past earnings multiples. Now it's sales multiples, and the sales multiples are crazy now, and people are jumping through hoops trying to justify the valuation. Oh, well, maybe if you flip the 10-year, then that gets you an 80% or 80 times multiple, or the justification that's going on, or rationalization for this market that's just having money pumped into it. What's the Fed doing? 120 billion a month. I mean, it's just crazy. And then the fact that anytime it, goes down a percent or two, everyone starts to freak out like it's the end of the world. That's an environment where we get a little concerned that maybe there's more fragility than people are owning up to. And so I don't know. Yeah, we want to protect against the downside in case the inflation that we're seeing in the natural resources does cause more of a widespread disruption, and kind of bring down a lot of other areas. At the same time, we don't want to step in front of a moving train. I think that's been the difficulty is, when everything's running so well, you say, well, how do I protect against it from changing? But I think given what I was just talking about, which is that a lot of the shorts, in our view, and this has been the case for a few years, we think that shorting a lot of individual names, even though they're at crazy nosebleed levels, is more of a market call than an individual company call. And so you really have to be making the statement that I think that the market's going to crash, because something that's trading at a crazy valuation might get even crazier. And so how are you going to protect against the pain that you're going to endure before you're waiting for the thing to turn? So I don't know. It's a long-winded way to say, no, we're not really shorting natural resource stocks here. We are more short, either short or we'll have, put options on just kind of more general market areas or specific areas within the market that we think are extremely overvalued, where if this thing ever does stop, if the Fed ever does, kind of let the thing correct, they'll probably be the most affected. I think that yes, in a general market correction, the natural resource stocks will probably get hit along with everything else, but they actually have strong fundamentals that are driving it. And so, it's always hard to be short something that actually has a reason to go up versus something that has been propped up by 10 years of central bank profligacy and just waiting for that bubble to pop. So we've lost money on our hedges. I think everyone, the joke about, when at the end of the year, if you have fire insurance, are you upset that your house didn't burn down? I think no, it's just kind of a necessary evil that you gotta protect yourself against the downside. But we're really only concerned about protecting against big downside. I think if the market were to drop 5 or 10%, I mean, we're not too concerned about that. That's the reason to find areas that do go up a lot when they work, because it gives you a little bit more cushion to endure some of that just normal volatility.
Yeah, I agree with most of your points. We consistently lose money on insurance type hedges. I think there is some hedge built into natural resource sector. Not initially, of course, as you know, everything gets cleaned out. So that makes sense to come back and look at some of the insurance options that are available to the broad market. And then I think, as you know as well, that at the end of the day, that initial washout, that really being in cash is a nice place to be parked, to selectively deploy opportunistically in the various areas, whether it's physical metals, whether it's picking at natural resource stocks when they sell off, et cetera. I think that makes a lot of sense. And I think if you have a blended approach to natural resource stock portfolio, plus cash, plus some optionality in terms of insurance on the downside for the broad market, I think that's a pretty good area to look at it. For us, I just can't get on board with trying to short any natural resource stock, especially a junior, in an uptrend that's generally sector wide, and it's really tough to do that. Even if it's a joke, even if it's a joke and it proves itself up to be a joke, it's just not worth the time and effort, especially if you can only scrape 50 to 75%. Why would you do that? I mean, you easily go long in some of these juniors and recoup many multiples of that, Brian, for less effort.
Well, and similarly, I think for us, even if we think a stock is or a company is not that good, if you're in the middle of or the beginning stages of a mania, we don't want to be short. We'll avoid it if we don't like it, and just concentrate in the ones that we do like. But yeah, I think there's a lot of blow up potential to be shorting. I mean, look at some of the performance of these stocks over the last 12 months. I mean, some of these things are up 5 or 10 times. So if you're short it, they might have been a poor company in your opinion 12 months ago, and you say I'm going to short it, and you can get blown up doing that. It just seems like the risk reward is skewed. I'd rather just if you don't have anything nice to say, don't say anything at all. Just avoid it. Don't own it. No one's forcing you to own any of these stocks. So find the ones you like and go along there. But I think some people might have the obligation to short. Maybe that's part of their mandate or whatever it is. I don't know. For us, we have a pretty broad mandate. We choose to have protection just because, like we've just been talking about. But in general, it's some of these things where we think that we're really only concerned if something breaks in a major way. I think we've gotten really used to pretty wild volatility here, so that doesn't bother us that much. Kind of your normal course thing, but if something really breaks, we want to have some protection there. The other thing that really helps us, you mentioned cash, is the way we structured these funds is we didn't go out and raise the whole amount at once and then plant the flag in the sand and say here we go, it's off to the races. We launched small and we've been steadily raising over time, and we still are. We still have money coming in pretty frequently. So that helps us, take advantage of opportunities like that and these sort of short-term dislocations in the market as you have some money coming in and you're able to deploy it. And then on the flip side, like I said, we have some core positions, but we might, trim around it just for portfolio management's sake. And so if something gets really out of line, something runs a lot in a very short period of time, we might rebalance it back to what we think is appropriate, and that might free up some cash. But in general, I think we just want to kind of, pick what we think are going to be the winners and let them win. And then in the meantime, we'll have some protection on the side and we'll see what to do with the cash. But, I think that's the way we've approached shorting it. Everyone's going to have a different way they go about it. I mean, there's a lot of ways to play this game. So not necessarily saying one is better or worse. I'm just saying what we're doing.
And there's a couple successful. They've kind of disappeared recently, but there's a few successful short sellers out there that target small juniors that come out with these short into short campaigns that work for a while anyway. But I think you're right. I don't think you need to pick up pennies in front of a steamroller on this one, especially in this junior sector. And yeah, I mean, some of the performances, even in the companies that are the crappiest, is substantial here. I mean, just looking back, if you just cherry pick some of these best performers going back to their absolute lows for the cycle, I mean, there's some stocks that are 3, 4, 5,000% gainers in uranium space from their bottoms for this cycle. So, and then also from the comment you made about cash, yeah, it's fantastic. It's like, the funds that have demand, new clients, and you guys are, taking new clients, that's a beautiful conduit for additional capital. If you're taking new clients and you have demand for your fund, which isn't always the case, as you probably know, Brian, it's kind of like equated to an individual investor or a family office that has income where they're able to still stack away half of that income towards their portfolio every month or every quarter or whatever it may be. It's just nice to see that extra cash coming in to help shore up the portfolio, because I think that continues to be such an important component of any portfolio. How about carbon credits, carbon market? Any thoughts on this trend?
Yeah, I mean, we've had a couple guys we've talked to about it over the last year or two. It's gotten a little bit more popular. We haven't done anything there. Just kind of getting up to speed on. We've looked at it a little bit. I guess it goes back to what we were talking about is, you can't buy everything as much as you'd want to. It's tough when you do all this work on a sector and it starts working and it's got a lot of upside, but then you got all these other opportunities that are calling your attention. And, oh man, should we, maybe sell some of this to buy this or that? And the FOMO kicks in and you want to own all this stuff. I think it's an interesting development, because if you do start having a carbon price that starts to bite a little bit, I mean, I think it definitely makes nuclear power look better. So as much as I don't really like taxes, I think that's an interesting development there, where you're going to actually start penalizing some of these sources for the emissions that they do. I mean, everyone talks about nuclear waste, but pollution is a form of fossil fuel waste. It just gets kind of shoved into the atmosphere, so no one really cares about it. But this might be a way to offset that. And no, we haven't really done anything there on the investment side, but we're aware of it, and it's probably something we should look at a little closer.
Yeah, pretty interesting trend on that front, and the nuclear power component of that should be a huge unbalanced credit in favor of nuclear power on that front. Brian, we probably should wrap it up here. I think we've been talking long enough, but anything on the front as far as if you guys are open, if the fund is open to new clients, can you just speak broadly to some of the requirements if you guys are taking new clients today?
Yeah. So the fund that I manage is a partnership. It's available to accredited investors. We have a couple other partnerships. Typically, our long short stuff is in that form, and it's available to accredited investors. We manage some long only, some SMAs that I think is more broadly available. So you can always just reach out to us. Our guys are happy to walk you through it. And look, we're always just happy to talk in general. I mean, people call us all the time to kind of pick our brain about stuff. So yeah, I think that the partnerships have a little bit more of a hurdle to participate in. But our long onlys, they're a little bit more diversified, but they still own a lot of this stuff. I mean, they're still pretty heavy in natural resources. And then we have a smattering of other names that we've done a lot of work on. People that, if you follow my partner, he covers a lot of that stuff. You can see on his Twitter, he goes over a lot of the names. So yeah, just give us a call in general. I mean, I think we have availability for most types of people, but for the partnerships, I think it's a little bit more restrictive.
Brian, and what's the best way for interested parties to contact you?
Me personally, I think you can just go on our website and reach out that way. Also, I have a Twitter you can follow. I'm not that active on it, but we'll post stuff anytime we have stuff to post, so they can reach out to me on there, or just reach out. There's a contact form on there. There's a phone number. We're a pretty small firm. We actually answer the phone, so just reach out. Happy to talk.
Well, Brian, really appreciate it. It's always fun chatting the markets here. I appreciate you taking the time, and best of luck in the coming quarters ahead, sir.
All right. Thanks, Andrew.